Welcome to Gamma On episode 6. I'm Oliver Renick, lead anchor for the Schwab Network, and we've got a great show coming up here. Brent Kochuba, the founder of Spot Gamma, is joining me, and we're going to talk about everything from the ground up to how it's impacting real live action in Microstrategy and the S&P 500. Brent's with me here for episode 6. Brent, it's great to have you on the show. Thanks for joining us.
Absolutely. Pleasure to be here and excited to talk to you.
Absolutely. I've followed you for a long time. A lot of the folks that we've talked to on the show are familiar with your work. I think a lot of viewers are definitely going to be familiar. So introduce us, though, for those who don't know you, what exactly you do at Spot Gamma.
Sure. So I have about 20 years of institutional derivative experience. I worked for a few banks and then an options market maker. I was a broker there and a family office. And so through that, I learned all about, and I came to see how the options market could really have a major impact on the underlying, specifically S&P 500. And so in January of 2020, I took all these models I had built for the family office and through my experience at various brokers and put those models up online and started to talk about Gamma on a daily basis. And, in January of 2020, it was about convincing people that the options market impacted stocks. And then, you fast forward to meme mania in January of 2021, and now it's a kind of a common topic of conversation.
Yeah, that's definitely something I kind of want to revisit a little bit for those who do have that as their reference point, the meme trading, the GameStop stuff. I also kind of want to take it back to square one a little bit. We're in episode 6 of this show, and some of the feedback I've gotten is that we started off with this kind of baseline, this grounding, and the definitions, the simple stuff, and we kind of then extrapolated on how to use that, how to calculate things like gamma exposure, and then kind of got into some of the philosophy of the broad second derivative. So to kind of help us bring it home here, when you talk with folks, like I joke that before every podcast, I go and I make sure I've got my definitions right. Delta, price moving according to how much the underlying moves. Gamma is the derivative of that. It's like I'm the guy who hosts the show that double checks his definitions. When you talk to folks and they're like, hey, what is gamma? Do you refer to the derivative definition, or do you refer to gamma as like a tool that can be used from a utility perspective?
Yeah, you bring up an interesting point because there's like two types of lingo. There's the flows perspective, which is, what is the impact of this to the overall market? And then there's, when you start to talk about structuring trades and things like that, you're more talking about, the derivative calculation itself, meaning, what is the gamma of the specific contract and what does that mean for me as an options trader? And so I think that as the, gamma analysis, the sector of study known as gamma analysis has grown, we sort of normalize this conversation of like, the GEX index or these different numbers, which kind of mean more to the market in terms of volatility as opposed to, what may happen with an underlying option, for example.
The other thing that I've seen you talk about, some of the kind of disclaimers that we always try to mention as well, is what do we know is actually happening when trade exchanges hands? What the motive behind that is certainly not obvious. There's also ways that we kind of paint with the broad brush in terms of dealers versus market makers. How much do you think this is like science? How much of it do you think is art?
It's getting better in terms of the science because the data we're able to start getting now is better. It's immensely more expensive to obtain a lot of this new data that's coming out, but we're really able to glean a lot more insights that are much more constructive to understanding how people are positioned. And in the past we could sort of understand what open interest is and where people are positioned. Then we could look at the volatility surface and start to understand, okay, if call skew is the highest it's ever been for GameStop, then we know people are long these calls, and we can look at the options chain and start to figure out where that is, right? But now we're starting to able to track positions. That's one of the things we started doing at Spot Gamma, tracking positions. We've been doing that since January to understand, okay, this is where we think market makers are short or long various calls and puts. We can wed that with a look at the volatility surface and monitoring volatility to start to understand exactly how people are positioned. And then you can, the value of that is that you can start to put together an understanding of how the underlying stock is going to react or may react to different catalysts, right? And that's what really the holy grail is if you start to believe or can start to understand that the market is pricing, that your price for or understanding of how much the market is going to move. In other words, my price for volatility is different what the market is, then I really have some edge, right? And that's really what ultimately it is we're trying to chase here.
I mean, I guess you would probably argue then. I mean, you got a service that's based on this, and you've done some really good analysis too about the relationship between movement in the S&P relative to gamma exposures. The notion that there is a correlation that is scientific in nature, that is kind of a pressure point for markets that kind of tells you when things might be starting to get more convex. I mean, I guess you would argue that this is a necessary tool in the belt to be able to deliver alpha, to discover alpha as a trader.
I totally think so. And, the trick with the options analysis is that, there's options trading in every single name. Basically, it's like, 5,000 different U.S. listed instruments, right? And so, the options impact is not there for every name all day long, right? But there's a certain subset of names where it is, like the S&P 500, day in, day out, what these positions are. They're systematic positions. They're very large positions. And, in there, you can see the impact of options, I think, on a daily basis, right? And then there's a kind of a second sector where there's rolling impact, right? It'll become the meme of the day, and there'll be a lot of options volumes and things. But you can look at in the S&P 500, which is certainly the largest options complex, there's a lot of robust statistical evidence. You don't have to overfit curves and things like that to find something, right? It's robust. You can see that the bigger these positions are, right, call selling positive gamma positions are, the less volatility we have in the S&P. You can see it with things like the JP Morgan collar trade. You can look at a chart of the S&P into the end of September and know exactly where the JP Morgan collar trade was positioned, right? Because we pinned that level. And if you're not aware of those options positions, then I think it messes with your understanding of how the market works, right? You're kind of flying blind in a lot of ways.
Do you have a favorite analog to use for folks who haven't thought about it from the sort of mathematical, quantitative way you do? For example, we talk a lot about guardrails sort of on a highway where you sort of understand, okay, here is the certain kind of, and I also kind of think about it from maybe to start from a trader's perspective is when I first started thinking about options trading, the implied move ahead of like an earnings report or something. And that was kind of the way you'd start to get a baseline. Okay, what is kind of the market expecting in terms of the magnitude of the swing here around some event? Whereas GAM is kind of that, literally to the second derivative where you seemingly kind of know, all right, here's the highway we're traveling down. Here's where some of the kind of expected guardrails are. They can bend. They can absolutely break. They usually don't break, but knowing how kind of the structure is breaking down or firming, is that a good analog? Do you have other ones that you like to use?
Yeah, I tend to think of it as like a hug, right? It's like, how hard are you squeezing me? You can squeeze me so tight that, I can't move my arms, or, it's kind of like a little bro hug where it's like, how you doing? And I'm free to go about my day, right?
Right, so there's convexity in hugging. You can go from comfort to death.
Yeah, that's exactly what it is. Like, and so when you look at some of these markets, the embrace is strong and it's long, right? It's there, it's solid, and when oftentimes that hug is going to stop, right? Because there's an options expiration, there's an event that's going to remove positions that free the market, to move. And to your point, I think the biggest, most consistent flow in the world is this options hedging flows, right, in the equity space. You can have a moment in time where, maybe a big pension fund comes in and they got to sell a bunch of spiders or futures or something for some reason, right? And that in the short term, let's say over the course of half a day, can move the market. But then this positive gamma flow, if it's in place for dealers, that eventually is going to come back in and kind of like right the ship, right? And so I think that's the other thing that is key here is that the hedging flow persists day in and day out all day long. And so you can have these short-term, exogenous flows that are a fund comes in, they got to sell $2, $3, $4 billion in a short time frame. They move the market, and then the options flows kind of bring it back into place, right? And so there's a kind of a timing and a path dependency, I guess I'd put it, to the way a lot of these flows operate.
A couple of really good points in there. I also like the ship being righted as the dealers and the market makers adjust accordingly, because I do kind of think about as a retail trader, as an individual, you're kind of trying to keep your balance basically on the ship that's being driven by these much bigger players. And if it starts to tilt one way, you want to make sure that you're either ready for that big move, because you will get thrown off. How much do you think I guess maybe from a size perspective or from an individual kind of versus institutional side, how much kind of ability do you think people have to maintain that balance given the size discrepancy versus huge dealers and market makers?
Yeah, I think the interesting thing is, as traders, we're all looking for an edge and trying to identify, what is my edge as a trader. And there are a lot of short-term movements. For example, if a big fund comes in and pushes around a certain name and you believe that, or pushes around the S&P and you believe that positive gain will come in and lift the market back up, right? As retail traders, we can express those ideas a lot more efficiently than a bigger entity, right? Because we don't have to buy 1,000 futures or something, right?
Sure.
We can buy one lot and monetize something. So I think that when you look at the underlying edge here, it's easier to capture that edge oftentimes, particularly with the use of zero DT options and short dated trading, and you can sort of operate in this interesting zone where it's like one of those little fish, I don't know what you call them, that's on the back of like a whale, right?
Yeah.
You can sort of
symbiotic.
live off the byproduct of these flows.
Totally.
And I think that there's a lot of interesting edge in that, for traders, because if you believe it's the hedging flows that are exacerbating a move, when those hedging flows stop, then moves should mean revert, for example.
Okay, and that's exactly kind of where I was going. I'm glad you go there, because thinking about the volatility surface and the way we've now chopped it up with so many different durations and the 0-day stuff, the kind of two-part question there was, one is how much does the 0-day and the short-term options give us that dexterity, a word that I've heard you use before, I think that people have to have. And then kind of the second part, because you already kind of addressed some of these, but the second part too is, do you find yourself in certain types of trades more than others, like structures of trades?
Yeah, that's a great question. So there's a cycle to volatility, I believe, and there's a lot of evidence for this. And so what I do tends to cycle with volatility. There are times where I think volatility is too cheap, and so I generally want to frame my trades under that guise of being long options. And then there's times, and it's between individual names too. But like if you just think of out of the election, right? And everyone knew that if Trump got elected, or believed that if Trump got elected, the market was going to go up, right? And people were even like, hey, this should be really bullish for Tesla, for example. But what people didn't appreciate is the potential impact of short-dated options flows into Tesla and leveraged ETFs and all these things that make Tesla go up a lot more than what the general market expects. And I think that it's hedging flows that exacerbate that moves. But what the sum of that is that calls were underpriced. And this is something we wrote articles about, so I'm not really saying this with hindsight, but it's about the price distribution, right? The market was pricing in, let's say a 50% chance of a 1% move. And I say, no, it's a 75% chance of a 1% move. So I want to be long options in that environment. What's interesting now, if you turn to the S&P 500, today's zero DTE straddle. So if you look at the price of a call and put at where the S&P opened, which is around 60, 80.
Yep.
The price of that straddle was $17. So we'll generally quote that in basis points. You take $17, you divide that by 60, 80, you get 28 basis points. So the zero DT straddle was 28 basis points, meaning that the market was pricing in only 28 bips of movement today, right? That is the lowest price since the COVID crash in 2020. So what that's telling you is the market is now pricing in no market movement. So the point of that is that now volatility, traders' expectations of volatility have gotten so condensed that I, as an options trader, can't go, I'm not going to sell that. Like, why would I want to sell the lowest volatility in the last 5 years, right? So, do I think that I want to get long options in this scenario? Do I think there's a catalyst to switch us from this kind of short volatility or low volatility regime to a high volatility regime? And so, these are the differences in price distribution. I can give you another example, very shortly. At 1:45 yesterday, Powell was speaking, 1:45 p.m. Eastern time, and the zero DT straddle at that moment was only $10, right? And Powell's a catalyst for the market. And so, you end up with this situation where the market immediately jumps when Powell speaks, and the result is that the S&P gets squeezed, and we close at all-time highs. And the end of day move there was $20. And so what I think happens there is people who are short volatility, right? If I'm short the $10 straddle and the market starts to move $15-20, I got to cover that position, and that flips hedging flows such that they go from volatility suppressing hedging flows to kind of volatility expanding, right? Because these cover trades induce volatility, if that makes sense.
Absolutely.
So so you got to navigate those waters.
Okay, so that's a really great example. By the way, we're doing this on D5th, so for context for those following along, because I love the use of the numbers here in some examples. And do you believe in these kind of windows of weakness, like Jem Carson oftentimes talks about windows of weakness? Do you feel that that's the way the market kind of operates now in between expiries?
Yeah, so I've done studies on this before and recently, and I think that was something that you could kind of set your watch to up until really this year. And I think what happens is anytime people become broadly aware of a construct, it doesn't work anymore, right? And so you start to see the market move oftentimes before options expiration, right? So before we would say, well, I'm going to play a pin into Friday expiration, right? But then the market starts to kind of shift on Wednesdays. And you could also see there's a correlation or there's an impact of whether the VIX expiration occurs before or after. And so I do think broadly that is a turning point, and it's kind of a window of weakness. But the kind of window assumes that there's like this, you arrive at the window and we go through it. And now it's sort of like almost like you're wading into a pool that gradually rises, right? You start to get used to before. And kind of what's happened, I'll give you an example, is like I wouldn't buy, so let's say I think that volatility is going to expand, which I do. And I'm like, well, I want to buy puts here because I think the market may correct. So I'm going to wait until Friday. But then the move starts on Wednesday. I'm like, man, I was going to buy 2-month puts or something. So like I got too cute and I missed the start of the move because I waited those extra 2 days. Does that make sense? So now it's like, okay, I know this is the big event, and I'm not going to be cute about the exact timing of it. I just know that around this time is when I believe things are going to start to shift.
Hard edges have softened, basically, the more folks try and preempt them or act on them. So I guess then, do we take that to the extreme, to the infinite, and say eventually the whole thing will get arbitrated away and it'll just become kind of one long diffusal? Or does the market structure will kind of always have that now hyper seasonality around it? Can you fully arb away the gamma edge? I mean, how do you think about that?
The call selling funds and the derivative ETFs are only growing in size, and it doesn't seem to matter that from a total return perspective that those products are not good, like JEPI, JPI. I mean, the return's not bad, but when you compare it to the S&P 500, you're objectively performing worse, right? And so these funds have, JEPI alone I think is $35 or $40 billion, and they sell every they sell essentially what amounts to 1 month 20 delta puts, right? They just do that every single day basically. They're selling these puts, right? And you see these funds also coming in some names like MSTR and things like that. And so my point here is that there are these systematic flows that come into the market that are only growing in size, and I think as long as that is there, then you're going to end up with a lot of these same dynamics. Like a lot of the flow has been pulled forward to the next expiration. I think that's true, but I think that the zero DTE mechanics operate inside of this larger cycle, which is tied to monthly options expirations, right? And these systematic flows are the same.
What about the potential to really exploit like the GameStop type stuff, or maybe Tesla to an extent? How often do you think, what's the sample size or the occurrence rate kind of those big moments? Are those once in a lifetime, once in annual? How do you view that?
They seem to be occurring with greater frequency now, and I think that GameStop changed, 2021, it changed the paradigm, right? I think it caught a lot of the market makers off guard, and you could just, we had congressional hearings about this stuff, right? And now people are smarter, there's more access to information, like you mentioned at the start. I was maybe one of two people talking about gamma flows outside of a couple of banks, right, in January 2020, and now it's kind of ubiquitous in some ways. And so people understand now the mechanics, and I think that people have better access to the tools and they're smarter. And so what that means is that when you get a FOMO, it's faster and it's bigger than they historically have been. And so, you just look at what's happened after the Trump election, right? We've seen these cascading chases into different products like Tesla and MicroStrategy and things like that. And so I think what used to be kind of once in a year events are now like once a month events that you can find, kind of across the spectrum. And what I think are the best trades, or what I oftentimes think are the best trades, is when I can find that there are these call flows that are creating excessive demand. And what I think happens in those situations is market makers are now kind of hip to the game, right? It's like, okay, everyone on Wall Street Bets or Twitter is suddenly chasing this name.
Right.
And so what they do is they react by jacking the implied vols up. It's like call skew jumps really fast, right?
And how do they do that?
Jump,
What's their mechanism
in a
for
major
that?
way. Yeah, and the reaction function seems to me to be a lot faster now. And so I love those situations because I can see call positions coming in. I can see people are buying calls. I understand why vol is going up. And it's a lot of time just a function of demand, right? Ever since there's been tulips for sale, right? People chase this stuff, prices get crazy, and then things tend to mean revert. And so I think that in the option space, we're able to express an idea that vol will come in a way that you really can't in stock, right? Like you don't want to short MicroStrategy, but do you want to, maybe a put isn't good, but you can buy a put for fixed risk, right? As just as an example. And you can you could trade ratios to bet vol comes in. You could do all these interesting things on price distribution that I think are really great risk reward scenarios. And I think my best edge is when I know it's just excessive demand and froth. I love betting against that kind of every time, right? There's situations where like in biotech there's some drug coming out or whatever, and so vol's jacked up. I'm like, I have no idea what's about to happen with that. And I don't need to, right?
You just know demand is outstripping the supply at the moment.
Yeah, and I think sometimes it's that way with earnings too. It's like, I don't know if Nvidia is going to have good or bad earnings, but let me see if there's an unusual move like we just had with Salesforce, right? And then after that unusual move, I can step in, and now that the event is out of the way, and structure a lot of interesting trades based around what vols are doing and the positioning that I see in the market. And I think that oftentimes people want to step in front and be like the hero, like I called the
right.
the big jump right. And I think a lot of times it's like, just wait to see things.
Yeah,
crazy,
come in after the battle and pick your spot.
That's right.
When folks are ailing a bit. To that point, a kind of specific one on the earnings side, then I think you just answered it, but do you find yourself trading after earnings? Does the vol that comes out after earnings increase your odds of success when the vol generally is cheaper?
I think it does. Salesforce we were talking about yesterday, where the vol immediately comes down after the event has passed. Like there's absolutely that component, but that does not mean that there's not volatility to extract, particularly in the morning after. And so with the short dated options in particular, I think you can get in there and be very efficient. And you don't have to delta hedge or do anything fancy. You can just trade straddles and strangles oftentimes, and that can work out. At the same time, there are occasions where you go into an earnings event and the call skew is incredibly, high, or the put skew is incredibly high because the market is anticipating. Like we saw this in Nvidia, right, over in like February and April, where everybody and their brother thinks, knows the earnings are going to be amazing, and so what happens is people start to skew the distribution to the upside too much. So even if the earnings are the best earnings you've ever seen, they can't possibly meet, the expectations that people have, right?
Yeah.
So that might be a situation to go, okay, I'll actually trade in front of earnings because people have bid up the price of these options to just such an extreme, and there's this obvious skew.
I mean, it sounds like you trade single stock. You see more opportunities maybe in single stocks than at the index level, and I guess that would make sense because you have more opportunities for outsized moves, which is when the gamma stuff works best. Yeah,
and I think a lot of times it S&P is my bread and butter because the options market's so large there.
Okay.
It's the biggest options complex far and away. But if you look at this current environment, right, like the vol is very, very low. there's not a whole lot to do. We're kind of just pinning, or kind of a time where I think vol is going to start to shift, and so it's a little bit of a waiting game. So then I'll start to look around and see, okay, is there a situation where I know the options flows are large, I know the vol is really shifting a lot, and those are the names that I like to go and play in, right? So like we talked 20 times about MicroStrategy today. I don't know anything about the Bitcoin. Trying to think of what the term that he used for it. What Michael Saylor's doing and all that sort of stuff.
Oh yeah, there's a Bitcoin treasury that he's making.
Bitcoin treasury.
His beehive or whatever, the hornet swarm. Yeah, it's a Bitcoin treasury. Yeah.
Yeah, it's very emotional, and there's so much talk about it and all that, and it's an interesting scenario because it's stock up, vol up, right? And so the scenario is, well, if the stock starts to come down, then vol should start to contract. And so, there's these interesting trades like 1x2s and things like that you can start to structure to set up those positions. And because things are so volatile now in this moment, it makes it, there's a lot more action there, and so there's a lot more trades to be done versus like you're going to trade the S&P right now with IVs at 10% and my catalyst isn't for another week, i.e. options expiration. There's just a lot less to kind of be done in that space. So
yeah, it's lower stakes. Where it's your buy-in can be big, but that's the only way you're going to get a lot of big return nominally. Whereas you go to somewhere where there's wild action, MSTR and others, then you're going to there's more juice to be squeezed. Do you think I don't know how much this is options related, but because of the options power, in addition to the financial leverage of MicroStrategy to the underlying, is there an analog here for Gamma itself that like MicroStrategy could start moving Bitcoin?
Yeah, there's this interesting thing that really showed itself in Nvidia over the summer, and you saw it in Tesla a little bit, and now you see it in MicroStrategy, where there's this financialization of everything. And what I mean by that is, a name gets a lot of attention, so what do? We're like, well, the options complex is really big. You can see that in daily options volumes, but then these guys roll out ETFs, and they roll them out like hotcakes, right? And so, if you looked at Nvidia, for example, I know this because I recently did a big study on it, there's 523 ETFs that have Nvidia in it. And so when Nvidia was really moving, you get the 2x Nvidia ETF, the 3x Nvidia ETF, right? And what I think happens is these derivatives oftentimes have to hedge with shares, right? But the amount of tradable float, like the amount of shares that are actually available to trade, starts to shrink because there's all this kind of systematic demand from options hedging flows and these other ETFs that I think you end up with a situation where there's just not much liquidity in the stock, and then that makes volatility go up a lot faster, right? And so you see that in Tesla, and I think that's what we see in MicroStrategy now, where you have 2x, 3x MicroStrategy ETFs. There's the call overriding MicroStrategy ETF, and that's not a big cap stock, right? But you look at what the biggest volume is on any given day lately, and it's MicroStrategy, right?
It's
so
it's huge. It's
it's
punching
massive.
way above its weight.
Yeah, you got these these convertible bonds, which I have a pretty limited understanding of how those work, but I know enough to know that there's hedging demand associated with that, right? And so the point is that these things are very financialized, and a lot of times people want to say, well, retail is the one doing this or that or the other thing. Like this morning, Friday call sellers came in and slammed MicroStrategy, $50 to $100 million worth of premium sold there in the matter of like 20, 30 minutes. Those are massive dollars for a small cap stock. And I think almost all of that is just systematic, a systematic function of these ETFs and these leveraged products that come out. And so to your point, that is all in a way just gamma trading, right? Because if you have a convertible bond and those big convertible bonds out there, well, they're just hedging, they're trading gamma around that, right? These leveraged ETFs, there's gamma around that, and so I think it can really exacerbate volatility in some of these stocks, and I think that only gets more extreme as we get more ETFs and more productization, I guess, of markets.
Hey Brent, great stuff. Thank you very much for your time. Thanks for being here. An excellent addition to our discussion, and we'll definitely do it again.
Love to. Appreciate the time.
Absolutely. Really smart stuff. Great way to explain the situation and a real-time impact for MicroStrategy, and also the backdrop here of what we're actually talking about with this stuff. Really good color from Brent Kochuba, founder of Spot Gamma. Thanks a lot, Brent, for joining, and thank you for joining me for Gamma On. Tune in every week for new episodes, and make sure you subscribe on our YouTube page for the full series. I'm Oliver Renick. Thanks for joining.